let's try and make sense of all of this. We've got a very special voice, Kenneth Andrade of Old Bridge Capital Johnson right now, to try and make sense of all that's happening around the world, juxtapose it with India, the 5 days of stimulus, the current valuations, so on and so forth. Kenneth, thank you so much for taking the time out and speaking to us. Good morning, Neeraj here. Can you make some sense about what's happening? Because a lot of people are trying to look at the economic decimation and asking questions about why should the index be at these levels, but then question marks come around liquidity and the global liquidity and how that might be supportive. How are you looking at the global piece and then the local piece?
Quite obviously, there's a lot happening, and it takes time to process all this information and data. So from 2 points, one is international and one is domestic, and obviously I'll touch upon corporate earnings and what are the ramifications of all of that. Yes, we've got the governments who have stepped into this pandemic across the world and trying to mitigate the economic disaster that is there, and everyone's supplied a different different levels of capital into the entire system. From an India context, I mean, if you look at a degrowth of between 5% or 10% within the Indian economy, given the fact that you're going to miss the first 6 months, you're definitely going to miss the first 6 months in terms of industrial output or in consumption spends. The government's essentially stepping in with a number which is roughly the same. So my sense is what we're effectively trying to do is stem the rot in the entire system. A minus 10% growth, 5% or minus 10% growth in GDP, and the government has stepped in, and you will get roughly you're anchoring roughly for a flattish year end in terms of the GDP numbers. So that's what's happening on the India side. I mean, you can go down to the specifics, granular specifics, to see where it is coming and how it is coming. Globally, they've done the same. There's some countries that have gone extremely ambitious, and there's some countries who cannot afford the kind of stimulus that the rest of the world is doing, who probably get left out with all of this. So 2020 calendar year and 2021 financial year, as far as India is concerned, is almost a washout year for corporates out here. What we need to realize is that just give up the first 6 months of economic activity and then concentrate on the second 6 months and see if we can pull back a significant amount of all of that. Of course, getting the supply chain and getting labor back into the system, all of this will have its own implications and how fast all of this can take place. But net companies and corporates are finding their way around. I think we'll come out of this pandemic a lot more efficiently than we've gone into it. And it should be good into 2021 from a profit and from a P&L standpoint, but more on the expenditure side, as corporate India will completely shrink its expenditure. So 2022 financial year, it's not as I don't think it's going to be as bad as most market participants are talking about it. Sure, we will crawl back. But forget 2021. We need to consider 2022. Last 6 months of financial year 2021 will give us some sense of what the following year will be like. So I'd say just concentrate on problems that are there, or in industries where the problems are, and just avoid them.
Kenneth, would you take actually a question that maybe I'll ask you later on. Okay, ignore the cash question. Let me just come to you about what do you think this whole start of the rhetoric between US and China might do to global sentiment, and if indeed global markets were to come off, could that have a corresponding larger impact on an already weak Indian market?
I mean, you've got to realize that one of the countries are going into an election. Right. So this rhetoric will be there. I think most countries that go into elections and have a weak economy at the same time during that period of time, they do start that rhetoric. But all said and done, if this escalates, yes, of course, asset markets globally will not fare very well.
Okay. So then would you believe that will continue to have an impact on the markets? Would it Would it bring the markets lower?
Uh, well, you have to look at the economic indicators and see what's happening. I think this is a century where it's not very easy to go into war because it's not very easy to go into war. Not because you can't, it's because the aftermath is going to be quite dramatic. So I think that's an extreme to look at. But if you look at things getting solved out in a period of time, yes, I don't think there's going to be I mean, the environment dramatically. I mean, there will be relocation of commercial structures or commerce structures that are there, but we will find our way around 2020, and you'll see some semblance of sanity returning in 2021 and probably 22.
Okay, Kenneth, we know that the GDP growth numbers, the corporate earnings, etc., are all going to look wobbly. In your portfolio companies, also, I'm guessing you must be anticipating some of these earnings to take a hit. What would you be doing? Are you already anticipating this, and do you believe that valuations might be discounting these lower earnings in some of the sectors, or do you think that there could be further hits if indeed the disappointments are larger than what people anticipate?
Neeraj, firstly, our style bias is more a little bit balance sheet driven than it is profit and loss driven. So in an income and expenditure statements, you always look at earnings per share. So if you're continuing to look at earnings per share, obviously 2021 is not going to be great. But if your style bias is looking at a balance sheet, which is essentially book value, then price to book is coming to a level where you're touching historical lows. So our bias has always been look at how value can be captured by portfolios on the value of the asset on the ground or the value of the business on the ground. And if the price or the market capitalization is equivalent to historical book values that you see and optically see, I think there is a very high probability going into the next couple of years where equity markets will generate a reasonable amount of even in the long term, a reasonable amount of return on your investments right now. When you turn to the P&L or the earnings in the near term, yes, there is an accident that has happened, and profits will fall off the cliff definitely for this financial year. But that if profits fall off the cliff in this financial year, the asset sitting on the ground or the book value that is there is still capable of generating a certain amount of return, a certain amount of earnings, and I think that's what we need to focus on. So the environment suits us. I think we struggled right from 2018-19 trying to find value in a business, but this is just from a investing bias or from a style bias. This suits us. This suits us pretty much fine. I think we haven't had it so good since 2013.
Okay. Kenneth, a sector that is probably not in the best of balance sheet shapes, but earnings look like picking up, and one of the 2.5 players are trying to mend their balance sheets as well as telecom. What are your thoughts here? Not the best balance sheets, but is in vogue currently.
So structurally, this the deterioration of balance sheets had to end, and usually this deterioration ends when sanity prevails and there's no more cash flow left to burn. I think we've hit the we are there. Whether it's a 2-player market or whether a 3-player market, I think 3 players will also survive, 2 players will also survive. But at the end of the day, it's a fairly mature business. I mean, the 3 participants or the 2 participants or the leftover participants have to agree to pull back profitability of that space, because it's not very cheap to run an infrastructure business in accessing such a large population. So I think we're at the bottom end of that entire cycle. We have seen optically, and we've seen it in some of the numbers that are coming through. That a lot of sanity is prevailing. My sense is a lot of them will exist over the next. All three of them will exist over the next 5 years. The choice is yours as to which one you want to participate with.
Okay, Kenneth, the call around a sector which doesn't have balance sheet stress, but it's a bit difficult to gauge, and that is autos. Valuations have corrected a bit, but the scenario looks completely off because while companies are saying that they might see buying, I don't foresee how with the earnings of individuals coming off so much that people will look to buy. If anything, they might even downtrade on what they would have wanted to buy if the P&Ls and the balance sheets permitted them. Any thoughts here? Do you have any auto exposure? Are you looking to get any auto exposure?
So this is a more broader question, and I'll answer that way. I think discretionary consumption will take a backseat for a little while. Like you did mention, there is a challenge as far as incomes are concerned, and it's not just domestic; it's something which is internationally prevalent. And if incomes are a challenge, then obviously you've got the ability to leverage into that cycle even lower. So from a consumer point of view, I think we will struggle to get demand back into the consumer cycle. And if we struggle to get demand back into the consumer cycle, obviously leverage is not going to be there, and there are challenges around companies who provide that leverage into that entire system. So no, I think valuations are nice in that business, but they're never going to regain their previous highs. Okay, and some of those discretionary spend companies had gone to historical highs in how market would want to value them. I think we're taking a pause on that. Things will normalize. It's not an industry that will degrow in perpetuity. It's an industry that will have a challenge for a year or two before it comes back to normalcy. But I think the best is behind us. The consolidation that was there the fragmentation in that business that was there will start to consolidate. A couple of companies will walk away with larger market shares, but it's not going to be such a high growth business as it has been in the past. But even for growth to come back, our senses is that it's going to take some time.
Okay.
So we don't own too many. We don't own too many we don't own too many automotive companies, and we don't we don't own anything which is there in the consumer cycle also.
Wow. Okay. I know you don't own financials, but you don't own anything related to consumers right now, is it?
We haven't had that for a very long time. So just to take that a step back into our portfolio construction, consumers, I mean, the consumer cycle and the financial cycle were intertwined. The financial cycle that did very well was essentially the value chain of the consumer cycle. So everything that did well was private sector banks, real estate lending, consumer finance, consumer discretionary finance, and everything on the opposite side were consumer businesses. So that's the cycle where we think where we were not very comfortable with both the fragmentation of that industry, as well as the valuations of that space, and we stepped behind on that.
Kenneth, the other question is this whole agrarian piece. Now, almost every company that I speak to says that the rural income is not looking all that bad. You understand this cycle better than most. What is your sense? Do you think rural and rural focused companies might actually stand to fare better? Rabi's looked okay, income somewhat okay. Escort's commentary seemed to suggest that. What is your sense across the different facets of that chain?
I mean, it's a relative way of looking at it, and agriculture, at least in the first half, will hold up. So the Kharif season is about 60% of the entire agricultural business, and most of it comes in this first half. I think that's holding up pretty well. On the ground, there is movement of all agri input companies. There is reasonable amount of demand, if it's not negative at least, for farm equipments that is there. So it's holding up. It's not as it's significantly better than anything that's got to do with industry or urban consumption. The caveat to all of that is agriculture as a percentage to India's GDP is just 15%. So I wouldn't bet I wouldn't bet too much of money in tending to believe that agriculture will pull India out of this situation. I think we've still got to find a long-term solution on how to handle rural population, because that, I mean, there's a disproportionate amount of money and a disproportionate amount of people in rural India, but not enough amount of incomes out there.
Kenneth, one final question. Where is it that you are most bullish on, if at all you're bullish? And where is it that you are very skeptical on? Whether you own in the portfolio or no is a separate thing altogether.
So we covered a little bit of that. The skepticism comes from the fact that incomes, and when will incomes come back to normal? And if incomes have to come back to normal, then obviously you will see deleveraging of the household balance sheets first before the consumer cycle starts, or before you see the enablement, before the consumer will actually get enabled to get back to its spending ways. Where I see the opportunities, and it's not that corporate India or India INC is woken up to the fact and gone ahead and got market share. I wouldn't blame corporate India. It's also our policy decision making. Is that there is a window of opportunity that India came across in the 90s, is effectively create an environment where you can address the global market share, and that's a positive part of it all. But we also have to look at it internally and create enough demand for companies to generate cash flows domestically, get those cash flows, and then invest it into businesses wherein they can go out and get global dominance. I think I'm reasonably positive as far as that opportunity is concerned. And whether our policies fall in place or not, some entrepreneurs will be able to create large business structures out of India. So that's how I'd look at it. That industry capex cycle, all of it will come because now for reasons of global trade or the dismantling of global trade, we have a significantly large opportunities come our way. The context of all of that, while it's a global commodity which exists and everyone's got the benefit of, if at all, energy prices have completely collapsed. I think between the two, that's where the largest opportunity is. We'll have to see which entrepreneur, which business house, or which business goes ahead and actually captures that cycle.
Okay, Kenneth, it's always great chatting with you. Thank you so much for taking the time out and being with us today and giving us your thoughts. Completely run out of time, but appreciate your time this morning. Stay safe.
Super. Thank you very much. Thank you very much.